SCHD is up about 1.7% by stock price in 2025, while the S&P 500 is up over 18%. Everyone's panicking. Reddit's panicking. YouTube comments are panicking. Should I sell SCHD? Is dividend investing dead? Did I make a huge mistake? No, you didn't. And what if I told you this so-called SCHD disaster might actually be the biggest long-term buying opportunity SCHD investors have seen in years? I've invested $5 into SCHD every single day for over 700 days straight, almost 2 full years, about $3,535 of my own money. And even after SCHD's worst relative 2-year stretch in modern history, I'm still up 6.4% total. And here's the kicker. More than half of that return came from dividends, not stock price. And I'm not stopping. I'm not selling. I'm doubling down because everything that crushed SCHD in 2024 and 2025 is lining up to reverse in 2026. Fed rate cuts, stretched tech valuations, and a rotation that could finally flip the script. Let me show you the real numbers. All right, here's my actual SCHD account with real money on the line. I started buying SCHD with that $5 per day back on January 1st, 2024. The market isn't open every day, so I simply batch the buys on trading days to keep that $5 per day average intact. As of today, I've invested $3,535 over 707 days. My account value is $3,761.84. I own 136 shares. That puts me up $226.84 or 6.4% total through one of the worst stretches SCHD has seen relative to the market. Now here's the part most people miss. Of that $226 gain, $121.94 came from dividends. That's 54% of my total return. Only $104.90 came from price appreciation. Over half of my gains came from income, not stock price. And those dividends have been growing. My first dividend payment in March 2024 was $3.13. And check out how they have continued to grow over the past 2 years. With my most recent payment in September 2025 was $31.38. And I'm really looking forward to the December 2025 dividend, which should be my largest by far. That's a 10 times increase in my quarterly dividend income in under 2 years. Yes, part of that is from accumulating more shares, but that's the entire point. The snowballing only works if you keep stacking. Now, here's the emotional part. In 2022, when the S&P 500 dropped about 18%, SCHD only fell about 3%. If you lived through that year, you know how brutal it felt watching portfolios evaporate. SCHD didn't make me rich, but it protected my sanity. Fast forward to 2025 and tech goes vertical. SCHD barely moves. Why? Because SCHD owns boring stuff, consumer staples, healthcare, financials. The S&P 500 is now over 30% tech. SCHD sits closer to 9 to 13%. It skipped the AI party completely, and that's exactly why I kept buying. Because in 2026, I believe the price appreciation side finally starts working alongside the income. Let me walk you through the 5 catalysts setting up SCHD for a potential comeback in 2026. Catalyst number 1, interest rates are falling and money always chases yield. Goldman Sachs expects a December cut plus 2 more in 2026, bringing the terminal rate closer to 3 to 3.25%. Bank of America agrees, calling for 2 more rate cuts through the summer. As rates fall, money flows out of savings accounts and bonds, paying 4 to 5% and into dividend-paying stocks, yielding around 3.8% with growth on top. By the end of 2026, that same money market could be paying closer to 3%. Suddenly, SCHD's yield plus dividend growth looks very attractive. Lower rates also reduce borrowing costs for dividend companies. Unlike mega cap tech with massive cash reserves, many SCHD's holdings directly benefit from declining interest expenses. That boosts earnings and supports both dividend growth and stock prices. Catalyst number 2, tech valuations are stretched to extremes. The Nasdaq is trading at a forward price to earnings ratio over 29, well above its 10-year average around 23.5. The S&P 500 sits around 24. SCHD's portfolio trades closer to 15 to 17. SCHD is roughly 1/3 cheaper than the overall market. Mean reversion doesn't care about hype. Expensive assets eventually compress. Cheaper assets eventually reprice. Multiple global institutions have warned that U.S. tech valuations are stretched. Even major hedge fund managers have turned defensive. I'm not saying tech is going to crash, but when money rotates out of expensive growth, it has to go somewhere. That somewhere is often value and dividends. Catalyst number 3, a growth to value rotation is likely forming. RBC Capital Markets expects value to outperform as investor nervousness increases. Bank of America has openly told clients to stick with value. Late cycle economic environments historically favor income producing stocks with stable cash flows. SCHD is built for that exact phase. Catalyst number 4, defensive positioning matters in uncertain environments. 2026 brings policy shifts, geopolitical risk, and late cycle volatility. SCHD holds companies that kept paying through wars, recessions, and crashes. Coca-Cola, Johnson & Johnson, Procter & Gamble, Cisco, Texas Instruments, AbbVie, Pfizer, Lockheed Martin. These companies don't disappear when markets wobble, and SCHD packages them with a 0.06% expense ratio, $6 per $10,000 invested. Catalyst number 5, dividend growth is accelerating. SCHD's holdings have averaged over 8% dividend growth over the last 5 years, faster than the S&P 500. As earnings improve and rates fall, that growth could trend toward 9 to 10% in 2026. And in taxable accounts, that income is qualified dividends, taxed more efficiently than ordinary income. Here's my on-record prediction for 2026. I think SCHD delivers a total return, including dividends, of 12 to 15%, while the S&P 500 lands closer to 10 to 13%. In my opinion, SCHD slightly outperforms the market next year. Why am I confident enough to say that publicly? Because all 5 catalysts are lining up at once. Rate cuts, valuation compression, growth to value rotation, defensive demand, and accelerating dividend growth. That combination rarely happens together. And here's the great part. Even if I'm wrong, if SCHD only matches the market, I still win because I'm collecting growing dividend income every quarter regardless of price movement. If SCHD does return 12 to 15% and I keep investing my $5 every day, my account could end 2026 above $6,000. But more importantly, my quarterly dividends could rise from about $31 today to somewhere between $45 and $50 per quarter. That is the dividend snowball at work. SCHD is for investors in their 40s, 50s, and 60s who want income and stability. It's for people investing in taxable accounts who want tax-efficient income. And it's for anyone who prioritizes consistency over adrenaline. SCHD is not for aggressive growth chasers in their 20s. If that's you, stick with VOO, VTI, or QQQ and maximize upside. SCHD can be a small side position, but not your main engine. My plan for 2026 stays simple. I continue my $5 per day investment. I reinvest every dividend and I let the snowball compound. I'm also documenting this entire journey publicly each month so you can see whether my prediction plays out or whether I'm completely wrong. These 2 brutal years didn't break SCHD, they built its foundation. I'm up 6.4% through SCHD's worst relative stretch in modern history, and more than half of that came from dividends. That's SCHD doing exactly what it's designed to do, paying you to wait. Thank you so much for watching. I'd love to hear your 2026 SCHD prediction. Let me know in the comments, and if you're not sure what to watch next, check out another one of my videos right here. Take care, and I will see you in the next one.